Guys, today we're at Gravit's HQ in Aldgate East. We're here to discuss all things M&A. We've actually got someone from Bonham Brook that's going to be discussing some of the tax changes that come in. We've got a partner from Gravit that's going to be discussing this. Now, the reason that M&A is actually important to the people like us is because if you're buying into a business, you're actually buying into property as well. And there's two strategies that actually go hand in hand. It's one not to be missed. Follow me inside.
Who are we? Where are you? So for those of you who've not been here before, this is Gravit's London office. Who are Gravit? So Gravit is an accountancy firm. We're an audit, accounts, tax advisory, tax compliance business. But we've come together over the course of the last few years because we're all part of other firms. There are plenty of people here from Gravit who are part of different firms over the course of the last 5 years, 10 years, 100 years, I think for some people. So Gravit is a new entrant. We've only been around about 3 years. But we're 600 people dotted across, the south and southwest. And so London, obviously here, Ilford, Oxford, Exeter, and Bristol. So some of you may come into contact with parts of us now in other parts of the country, because I know a few of you have come from further afield than just London. So that's what we are. What we do is on the right-hand side, we do what all accountancy and audit firms do. We just do it better, we hope, than most others. That's our role in the world. We're also a member of something called DFK International. I've been a member of DFK for about a decade now. They're an association of global firms. So if you've got interests or issues in another country, Germany, France, Dubai, many people now have issues in Dubai, that's what's happened, then we have friends over there that can help you. So it works very, very well. And we spend time with them. We're off to Edinburgh in the not too distant future to go and spend time together at our international conference. So that's what we are and what we do.
Anybody know which country in the world has the highest burden in terms of property taxes? The UK. Absolutely right. As a percentage of GDP, we pay 3.7% in property taxes. That's 115 billion pounds goes in property taxes every year. It's one of the few things that we are number one in the world at currently. Number two is the French, number three is the Canadians, and then it drops down. So my role in life is to reduce the 115 billion pounds which we give to the Exchequer for them to either, depending on how you look at it, waste or use carefully in developing the infrastructure and our society. So that's my job, just to reduce the money that we spend to people around property. I presume you all heard last year there was a change in the legislation to do with the tax allowances available regarding furnished holiday lets or holiday lets and serviced accommodation. Before I start going, has anybody in the room got a serviced accommodation or a holiday let? Really, where's yours? Greenwich. Greenwich, UK or Connecticut? UK. Okay, so you would have been able to make a big capital allowances claim on purchasing your property. Did you know? All right. Now, it's one of those things that, to paraphrase Michael Caine, not a lot of people know. Somebody laughed anyway, so obviously from my generation. But basically, there is a tax relief available to people who invest in commercial property. It's called capital allowances. That tax relief currently extends to holiday lets and to service accommodation, providing they have got income and what's called qualifying activity flowing through the business before the end of last month. So if you're just starting up, you've probably missed the window for claiming. If you haven't, there's still something you can do to get some tax relief based on the investments you've made in your commercial property. I used to be an accountant and I got better. Then I went into construction and I got better, and I've ended up doing something which is an amalgam of all these things. To do an effective claim on a property, it helps if you know a bit about law and if you know about construction and you know about accounting. It's a kind of Venn diagram where all those three things overlap. And luckily, me and my guys in the team I have fit in the middle of that Venn diagram so we can help in many different situations. And just to give you an example, top case study is a property near Hadrian's Wall in Northumberland. Okay, a big landowner has a lot of land near Hadrian's Wall. They buy a kit of effectively Swedish homes you can build. It's a construction kit, cost about 187 grand, building it themselves, and then start letting it as an Airbnb. Very low costs, almost no land cost because they have the land already. £60,000 turnover in year one. There's a payback of around 3 years. After 3 years, they completely pay back everything that they've invested in the property. So speak to my friends over here, not a bad investment compared to some of the things that we see. It's a company that does it. They pay 25% corporation tax. So of the 187, they get £65,000 of tax relief and tax savings in terms of cash they don't have to spend with the government of about 16 grand. So not bad. And a big enough figure for my client to think, well, that's almost 10% of that. So I can keep going with these properties and these properties and these properties. Second one is actually in York, which is my hometown. This is a flat that's bought off plan in a rather square looking modernistic block, which is completely different to most of the buildings in York. Slightly bigger price, bought off plan, person never lived there, £87,000 tax relief based on a 385 investment in property. Again, York's a really good place to have a rental property because the occupation levels are very high and the yield is very strong. This person is a 40% taxpayer, as you can see, and it's ended up saving them about £35,000. So there is still a window for making these kind of claims. If anybody's interested in this particular service that we offer, let me know. We'll have a look at things. There's a no obligation initial review that we can do. If you want to go further, we'll do it. What I know as somebody who's been in construction and working in real estate and working in accountancy firms is that when you buy a big commercial property, sometimes something called capital allowances falls between two stools. And an accountant will look at a solicitor and go, you're doing it. A solicitor will look at an accountant and go, you're doing it. And just when the transaction is about to complete, the client will say, who's done that? So we've come up with an idea, which is getting a lot of traction with solicitors who really have their nuts on the line, so to speak, if this all goes wrong, that we can manage this thing that nobody else really seems to want to manage. So it's a kind of brand new service, which is all to do with supporting transactions from purely a capital allowances perspective, not the kind of things that you chaps do in terms of DD and valuation and all that big stuff. It's a very specific part of a commercial transaction, which is small, but it often stops things happening because at the last minute, somebody will realise it's not happened and a deal is either slowed down or breaks because of it. So brand new service. Anybody who's got commercial property and is interested in a new service to do with helping commercial property transactions operate more cost effectively and smoothly, again, just let me know and we'll talk you through it in a bit more detail. On the right hand side is my pathetic attempt at art because it is very new. We kind of place ourselves in the middle of two triangles here. We can make the transaction happen by managing the paperwork, of which there are three things in England for managing the capital allowances on a transaction. And we can sit here between the buyer, the seller, and their various advisors, which could be a funder, solicitor, accountant. That's all from me. If anybody wants to ask me any questions afterwards, please do. And, you know, good luck with your holiday let.
Promised a reasonably interesting transaction that we was involved in during COVID. As I say, I get involved probably in about 5 or 6 transactions a year on multiple different types of industries. And when they do come across my desk, it is the most interesting thing that happens, obviously in the year, or one of 5 things that happen in the year. So we all jump on it and we really like doing it. And this was very interesting for a number of reasons, which I'll go into. So in August, September 2020, got a phone call out the blue from a banker that I know. He said, my client's in trouble. Their current accountant has got very worried and very scared about the fact that they're looking to sell their company with the properties in. They don't know what they're doing. They're a bit out of their depth. Can you help them get it over the line? So when I spoke to the client, I talked them through it. They've got the buyer. It's a big pension fund. They want to buy the company. The company owns 2 commercial units worth 20 million, and then it also owns a site worth about £1 million as well. The pension fund only wants to buy the 2 commercial units for 20 million, doesn't want the other site. It's got a director's loan account in the company. The previous accountant was telling the sellers, there's no way you can sell this company with a director's loan account in. Absolutely nonsense. You've been using the company as your piggy bank. There's no pension fund in the world that will buy it, all this stuff. So we get them in September. There's a lot of work to be done, but we tell them it's not going to happen overnight, and they're a bit worried that the deal's all going to fall through, and we say no. They're a pension fund. They know these things happen and take a while. So for 3 months or so, it was acting as sort of therapist to the client, as well as, or the clients, as well as the accountant who was doing the nice simple accounts, tax return, VAT returns, keeping all that stuff going, but also on a sort of a weekly basis almost, trying to keep Grant Thornton updated, who were the buyer's accountants. What the current management accounts were saying, what the current bookkeeping was saying, changing all things like accrued income and service charge accounts and all this sort of stuff. The previous accountant hadn't really kept it all up to date. So we brought it all up to date. We deal with our lawyer. We're talking to our lawyer. We're working on the transaction. We work on the SPA. And then obviously it comes to a point where I do mention to the client that the buyer is getting a rather handsome saving on the fact that they're buying the company rather than buying the properties themselves on stamp duty. That's largely why people want to buy shares in the company, because the stamp duty is less than the SDLT that they would pay on the property. So I raise that to the client. The client says, well, that's interesting, I might renegotiate the price. So we go back to the buyer and we try and renegotiate the price. There's a bit of give, there's a bit of arguments actually, which I started, but there's a give and take, and actually they do get something out of it in the end. So it's worth a negotiation. We lead that, us and the lawyers, we lead that, because like anything, if you get the buyers and the sellers involved too early, they'll sort of hit heads and it will become a bit messy. So as the advisors, we start that process off, sort of light the fire and throw away the grenade and then run away. But we sort of handle all that. So then it comes to the SPA and we deal with all of the accounting and the tax work, and Tom and I worked very closely on this. The real result was that we started it in September, we finished it all at the 4th of December. I think it was very late, but it was all during COVID, which is sort of a messy time anyway. So everybody on the transaction, certainly on our side, we're very, very happy with that result. We thought it was very good, considering we had all the other things to sort out. We had to get up to date with what the company was doing, because obviously we didn't have a clue about this company, no historical knowledge. So we had to sort of do all that handover, deal with the previous accountant. There were some problems with shareholding as well. So I think that 20 years previous or something, the company had bought back some shares from a previous shareholder. However, it hadn't done it correctly. And therefore, the only people that will ever find that out really are people when you come to buy a company, because then their lawyers will have a look over the share register and all the stuff that's happened historically, and they picked it up. And again, that's another reason why the previous accountant panicked and said, you can never sell it. Of course, we worked with our lawyer. It was sorted out within weeks. We had to go to get a court order, but pretty much, if people who know, you know what you know, and I guess you don't know what you don't know. So us and our lawyers knew what we had to do. It wasn't the end of the world. We dealt with that. But the biggest thing that we're going to deal with on these transactions are working on the SPA and the restructuring. I mentioned that £1 million site they didn't want. So then we had to sort of set up a new company, sell it, or sold it from this company to the other company, and talk to the buyers all about that process as well, to keep them updated, because they wanted to make sure there was no taxes on the company. So we sort of had to set up that structure for it as well. So that nice bit of restructuring work as well. So the real sort of work is in the SPA, making sure that from an accounting and a tax point of view, everything is covered off from our sort of on our sales side. Yeah, it's a very anxious client, but the good news story is obviously that happened, and then obviously we've remained very close with our clients since, because they're very trusted now and all this sort of stuff. But it all sort of came together, and it was a sort of a good working collaboration between us, lawyer, myself on the accounts and and just the advisory side and the tax team as well, that sort of pulled out all the stops to get it over the line. The other thing that happens as well after a transaction is you have completion accounts to do as well. And invariably, there'll be an argument about who prepares them and who reviews them and what have you. And we put in there that we prepare them and we get it reviewed by the buyers because we had all the paperwork. So it was on us. We did the completion accounts within whatever it was, 4 weeks after the transaction. Our client got paid everything they should have got paid, walked away very happy. And happy client means they pay on time and they come back. So it was a very good sort of case study, as I say, that happened through COVID, and we got some very nice sort of comments from our client as well. But that's an example of, it's a larger property transaction that we do, but there's probably anything in the range of £1 million to, what was the hotel? 100 and something. So anything in between, but all the same. The point is all the same problems exist. You've still got to go through all of these things. You've still got to deal with these things. You've got to share with the lawyers and the accountants on the other side. Hand over to Tom to talk about earnouts.
Before I start talking about this, typically with deal structuring, you do it first. It's the first thing you talk about. What does a buyer want? So how are you going to get yourself there? In that one, it was fairly easy. We just strip out the property with £1 million. But in more common cases, what you end up with is a business that's grown organically. There's things everywhere, and the buyer doesn't want all of that. The buyer just wants little bits, right? So we go through a process of understanding all of that and then restructuring it out. That's where people like me come into it, and we try and help out and work with the team. So this M&A, we do a lot of M&A work, a lot of transactional work, a lot of advice on structure, a lot of advice on how to help both sellers and buyers go through and navigate the process. Some of it is a bit combative, as Dan was just explaining. It can be a bit interesting dealing with KPMG. That's always a blast. But we are trying to get to a result for whichever side of this conversation we're working with, but equally knowing that it's probably better for both sides that there is a transaction, right? There's a lot of cost that goes in, so we try and work towards an end result that works for everybody. It just makes our lives easier as well, to be fair. So what's this one? So we work for what is a fairly well-established global recruitment business, I think is a reasonable way of explaining what they do. They're based here, but they've got people and activities all over the place, right? Not in the States, but pretty much everywhere else. The majority shareholder in the UK business wants out. He's had enough, right? He's got some people that are also like pseudo shareholders, option holders over some shares in the company who are going to get paid out on the way out as well. So they'll be probably quite happy. The business is selling for 100 million quid. So I thought I'd just trump everybody else's numbers that have been coming up during the day. I thought, I'll just pick the biggest one I can think of. So 100 million quid. So that's what it's being sold for. So it's a big number. So it may be payable immediately. This is the bit about M&A and sell side, right? When are you going to get your cash? How long is it going to take? And what are the claws that they've got into me in order to make sure that I still work there? And how am I going to get paid for this? And where are the tripwires? Where are those situations where it's like, if I do that, or if I don't do that, then I'm not going to get my full value. And on the flip side, what can I agree, right? What can I agree to get extra? What's that added value bit? Can I get more just because business has improved, or I've done something else, or we've started a new part of the business in South America or whatever? How do I make sure I get access to that growth and value? Right? So clawbacks and additions, they're really important to understand. So working with, it's not necessarily me, right? It's Dan and the team who will sit there and work with buy side and sell side to understand how the metrics work. It's all very well having a good idea, but if you don't get it into the SPA, it's never going to work for you. Make sure you get it right. So most deals work out with a 3-year earnout, right? Most deals, that's how it works. So you end up hanging around for 3 years, helping out, right? trying to make sure the business transitions from where you were to where they are, right? That's how that typically works. Some people can live with it, others can't. I've seen both sides of this conversation. This guy in particular probably wouldn't do that, won't do that, right? He'll just help along the journey. He's not going to be an employee running around to do people's bidding, right? He's got 100 million quid in the bank. Why is he going to do that? My chart of this job is this. If he stays here, he's going to pay 24% on 100 million pounds. Yes, he'll get business asset disposal relief, but he doesn't care, right? He's going to pay best part of 24 million pounds in tax. You keep trying to remind this guy, that's still 76 million pounds net, mate. You're going to be okay. But why would you do that? What's the benefit? So how can we help? How can we help him mitigate that liability? Well, I can't, unless he wants to pay me some of it, it's probably not going to go down, right? So what do we do? It's quite horrible. So we try and structure it in such a way that he only pays it when he gets the cash. He's going to get it over 3 years, 33 1/3, right, every year. So we hide the gain behind a loan note. If anybody's familiar with those, there are two different types, qualifying and non-qualifying corporate bonds. You want the non-qualifying one. Make sure that if you do one of these things, it has a clause within it, which means it can be converted into another currency, dollars. I know it sounds stupid, but it's really important. And the reason it's important is if it goes wrong. So if you get a loan note, what you're doing is you're deferring the liability until you get the cash. But if you get less cash, right, the qualifying corporate bond doesn't allow you to use the loss. We're working in this world. And you have option holders, which are under an EMI scheme. EMI schemes, employee management incentive schemes, are the good one, right? So if you're an employee or you have employees and you want to incentivize them to help grow your business, talk about EMI options to them, right? You give them an option to buy shares if things go well for them and for the business, right? Everybody wins. Typically, EMI options are only exercisable when you sell, which is what was the case here. So you sell the business and they get paid out. They don't need to hit the criteria for BADR. They just have to have the EMI options. They don't have 5% of the shares, they just have to have held the EMI options long enough. So it's a big win for them. 14% is the tax rate now, somebody will correct me, it's going up. It's great that we don't reward entrepreneurship in this country anymore. I think that's a brilliant thing. Well done us. But as I said, the majority shareholder has no desire to pay this 24 million quid. People might plot the picture on the right-hand side, have a little guess what happens next, right? Non-residents do not pay UK capital gains tax on the sale of UK assets unless those assets are UK property related. The end, okay? So if you've got a share in a trading company in this country and you get on a plane, what's the date today? Before Friday, jump on a plane, go to Dubai, become tax resident in Dubai, and don't come back for 5 years, and you sell that business whilst you're away, you're not paying tax in. Full stop. And you're not paying tax in Dubai either, probably. I'm not a Dubai tax advisor, but I don't think they've got a capital gains tax rate over there yet. He also doesn't want to live in Dubai, right? Where he really wants to live is somewhere in Spain. So what he does is he goes to Dubai, all right, lives there for a year, does what I'm about to explain, and then goes off and goes and lives in Spain. That's the plan. Whether he will or not, we'll find out. He's a massive Liverpool fan. So I suspect he'll be coming back every now and again to watch them play. But if the way it works, don't be here at midnight, then you're fine. Okay? Doesn't count as a day. How weird is that? So, we sell the business, but we sell the business before the end of the tax year. So he's still here, but he hasn't received any cash. We stick it behind a loan note, right? So the gain gets deferred. The cash lands in his bank account, hopefully, some point later this year. Once it does, that gain is triggered when it gets released, which is next tax year. And he's in Dubai. No tax. Don't come back, don't have the liability. Easy, sort of. So that's the kind of thing we do with clients. It only works in certain circumstances. We've worked with, this is quite a sad story, we've worked, I think, Makeda and I, as one of the private client tax partners here, talking about this the other day. We think we've advised what's about 50, easily 50 families to leave the country over the course of the last few months. How sad is that, right? I mean, it's madness. This is what's happening. They ain't coming back. That's wealth and creativity and industrially, like, it's mad. These people are gone, right? But yeah, they've probably gone there for a little bit. Some have gone to Spain, whatever. So that's an M&A earnout. couple of things I've put on the slide just to bring to your attention. The way tax rules work is that if you sell and you've got an upside to your sell, you have to value the upside and it gets taxed up front. So let's say you sell something for £1 million, but there's a possibility you might get another £500,000 if things go very, very well. You're paying tax on 1.5, okay? Unless you use loan notes. So that's quite an important thing. There's no way around it. If you don't get the 1.5 and you get 1.3, you get the tax back on the 200 grand. Don't worry about that. If you get more, you pay more tax and you pay interest. So getting that valuations right is quite important. It used to be a case law, but now it's sitting there square in legislation. And there was something else I was going to mention. A lot of this stuff, so we were talking to some clients this morning as it happened, and they're involved in Formula One, which is my love in sport. So I'm sitting there trying to talk to them about Formula One, and they're trying to talk to me about their business. It's like, no, we'll talk about that later. I want to talk about this. So what they're concerned about is when they sell their business, how they're going to interact with it going forwards, and getting that inside the SPA, getting your relationship with the business not nailed down, right? You don't want to be at the beck and whatever of the senior management that turned up and bought your business. You sort of really want to be engaged. You want to make sure that your futures are secure if you need that in your life. It's quite important to them. So just to make that point as well, that all of that can be done as part of the process that we go through with the clients up front. So that's it really. There's loads more stuff about M&A. So if anybody's got any questions about this, what's this? There we go. I don't have to talk about this. Basically, when you buy a company, you buy its history. So just bear that in mind, right? If you're on the buy side, you're buying its whole history. That's why you need people like us to go through it with a fine tooth comb and pull out all the bad stuff. And what is bad stuff? Savings, basically, right? If I find a 100 grand problem, guess what what happens to the price? So that's quite important. But between us all, collectively, right? It's great, that new service. I didn't realise you were doing that. That's brilliant. So 198 elections and 199 yeah, please take that off our plates. That'd be very helpful. So there's the DD stuff, right? That understanding what you're buying and getting prepared for sale is really important. So if you're on sales side, get someone like us to go through your company and understand it and go, that's a problem, that's a problem, that's a problem, let's fix it. Because it will just cost you money, right? So that's us, that's what we do. Quite enjoy it really, it's quite good fun. But has anyone got any questions for anybody of us?
Many of the families that you advise to go abroad to save tax regret that decision?
Not yet.
Speaking as a professional advisor from your point of view, very lot of people went to Monaco used it, and that was, figure abroad there.
Yeah, Monaco's a challenge. I mean, from a cost perspective, tax is only one part of the conversation. So I'm sure average property price in Monaco is £58,000 per square metre. Behind Portier, which is the corner that goes into the tunnel, where they've reclaimed some land to build a new flat, 98,000 average for the apartment, average per square metre. I was thinking about that. I was like, that's that. How is that 98 grand? So that's a good question. There have been, so historically people have done it and have regretted it and have come back. Yeah. Once upon a time there was better ways of doing it, but these days it's 5. You're right. I mean, it's not that easy to up sticks and leave. You do. It's important. Yeah. Yes.
I think he's going to find it tough. He's gone through 30 years of living with everything.
Yeah, well, yeah, exactly.
That's a long time. But 5 years, I think he's going to find it tough to not see his daughter.
I think that's right, and I think he's not going to move his. So this is the family question. This is where it comes down to, very much like, can you really do it? It's all right if your family is already somewhere else, it's easier. But if they're not, it's super hard. You miss the things that are familiar to you. You miss being able to go to the pub and watch the footy on a Sunday afternoon. You miss all the golf courses. You miss the rain. I mean, it's just a crazy thing. You talk to guys, it hasn't rained here for 6 months. So it's good. Any other questions at all?
When you said that you can't come back at all, that is completely in the value. Obviously, you joked about leaving before midnight.
Tax residence. So you can't become tax resident again. So UK tax residents based on something called the statutory residence test. It's basically a flowchart. There's one on our website, there's one on everyone's website. You've probably got one as well, right? And they're all basically the same. And it identifies the rules. So you're definitely non-resident, if you meet some rules, definitely resident, if you don't meet them but meet these, and then there's a whole connecting factor nonsense underneath. But they are the rules of the game. So if you're gonna leave, you need to meet these conditions, and it gets easier the further away from when you were tax resident. So the first couple of years it's a bit hard to stay away, but after that you can be here more. That's typically how it works. But when you've got family here, you know, daughter phones from school, daddy, I don't feel very well, blah, blah, he's on a plane. Of course he's on a plane. And that's where the problems arise. But midnight, the day is at midnight. So if you come here early doors on a Tuesday morning and you leave late Wednesday, that's one day, usually, unless you're working. Most of these people don't do that anymore. Anything else?
Does it make any difference if you have a dual nationality?
Nationality, it used to. So domicile used to be a really important point. We're now straying into non-doms, but with domiciles used to be a really important point. But no, tax residence is about where you are. So like somebody who's not supposed to be here, right? They're still tax resident. We're still going to tax you, right? It doesn't matter. So but your domicile can affect other things from a legal perspective, and it used to affect tax. It still does until Saturday, and when it all changes. But yeah, dual national. But it's nice to have one because you can travel. I now can't. I have to get in queues. Yeah.
You don't actually have to fully relocate to places like Dubai.
No.
You set up proper structures like holding companies where you can set up a service company, carefully, successfully move profits and then reduce your overall liability. So you could stagger it over a period of time.
Absolutely right. Yeah. I mean, you can. It's horses for courses. You know, sometimes that's a very sensible strategy, depending on where you go. For other people, you do it in one hit. We don't withhold tax on dividends either. So if you've got a UK company and you go and live in another country that doesn't tax dividends, you just strip all the profits out once you're gone. 5-year rule still applies, but you're not going to get taxed on it, not here, not yet. All right? Rachel from accounts will find a way. Okay. Thank you for all the questions. Thank you everybody for coming. Thank you everyone for speaking. So please help yourselves, and thank you again.
So we're at the Gravitar HQ with Savoys Club and the 5D gang. Some fantastic talks from the speakers from Bonham & Brook and Gravitar as well. Really thought the case studies was useful. I definitely felt like the room took a lot of value from it. It's the second time being here and can't wait to come back.